Let us talk about the absolute blueprint of how the system operates at the highest levels of capital and political power. Because what just dropped in the federal election disclosures is a masterclass in institutional leverage. Imagine writing a $5 million check to the exact Congressional Leadership Fund backing the very people who are actively structuring your oversight deposition. That is exactly what Commerce Secretary Howard Lutnick did, writing a massive $5 million donation to the principal super PAC supporting House Republicans just 5 weeks before walking into a closed-door congressional oversight hearing concerning his extensive historical interactions documented in the Jeffrey Epstein files. When you look at this as a retail investor or someone trying to build generational wealth, you have to understand that the global financial architecture is heavily influenced by access, narrative control, and systemic leverage. The filing itself originally contained a massive error, listing Lutnick as the active chairman of the financial services giant Cantor Fitzgerald, a family office setup currently operated by his sons, despite the fact that he has been serving as the United States Commerce Secretary for 19 months. This immediately raises profound questions about where public policy ends and corporate influence begins. But our job on this channel is not just to be shocked by political theater. Our job is to break down the mechanics of money, understand risk exposure, and build a bulletproof portfolio that survives while the elites play their high-stakes games. If you examine the actual transcript of the congressional interview, the legal realities are incredibly intense. Even though Lutnick appeared voluntarily without being sworn in under traditional oath, he was explicitly reminded that under Title 18, United States Code, Section 1001, any knowingly false statement or intentionally deceptive omission to congressional investigators carries severe criminal penalties and federal prison time. The friction in the room became undeniable when Representative Ro Khanna took over the questioning for the Democrats, confronting Lutnick regarding statements he made on a public podcast where he claimed that the massage rooms inside Epstein's home were actively recorded on video, and that Epstein was fundamentally the greatest blackmailer in financial history. When pressed under the threat of federal prosecution, Lutnick rapidly backpedaled, claiming his previous definitive assertions were merely raw speculation for media content and that he possessed no personal first-hand knowledge of individuals being blackmailed. This extreme pivot demonstrates how public narratives are constructed for mass consumption, while the real data remains protected behind institutional walls. From an asset management perspective, this level of corporate and political volatility is exactly why retail investors must maintain strict discipline, objective analysis, and a relentless focus on sovereign wealth building. You cannot predict when a cabinet secretary or a major market maker will become embroiled in an institutional crisis. But you can absolutely control your personal cash flow, your capital allocation strategy, and your asset diversification. When the House Oversight Committee Democrats emerged from that room, calling the testimony embarrassing and asserting that the entire event represented an egregious cover-up of elite network operations, the broader capital markets barely flinched. Why? Because the market is an unfeeling machine that prices in risk, liquidity, and systemic continuity above individual morality. The real lesson for our generation of investors is that traditional systems of corporate governance and public trust are shifting, and relying on the perceived stability of institutional players is a dangerous strategy. We must look at the structural facts, prioritize cold hard liquidity, invest in high-quality cash-flowing businesses, and build a diversified moat that protects our families from macroeconomic fallout. The fact that a sitting cabinet official listed his private family office as his primary employer on a 7-figure political donation right before a major investigation shows that the boundaries of corporate power are completely fluid. If you want to achieve true financial freedom, you have to stop looking at the news as mere gossip and start viewing it as a roadmap of institutional behavior. You need to ask yourself where capital flows when trust in leadership erodes. Historically, during periods of institutional decay and political scandal, capital seeks refuge in hard assets, decentralized networks, and hyper-efficient global companies that operate independently of localized political theater. That means optimizing your portfolio with a heavy emphasis on resilient equities, strategic real estate, sovereign debt management, and technology sectors that drive structural productivity regardless of who occupies the Commerce Department. Let us get hyper-practical about how we manage our capital allocation when these macrostructural shocks occur. The first rule of financial survival in an era of institutional volatility is the absolute preservation of liquidity. When you see multi-million-dollar checks moving between private equity chairs and congressional oversight PACs, you are seeing a playground of access that the average investor cannot participate in directly. Therefore, your edge lies in speed, flexibility, and absolute clarity of risk. You cannot afford to tie your capital up in illiquid, speculative ventures that rely on political favors or regulatory approvals that can evaporate the moment a new congressional transcript leaks. You need to build a cash cushion that allows you to capitalize on market panics, because when headlines like this drop, mainstream media drives emotional selling, and emotional selling creates massive mispricing in high-quality assets. That is your entry point. Second, look at the corporate structure itself. The Cantor-Fitzgerald crossover in the filing reminds us that the true engines of global wealth are family offices, private trusts, and generational asset holding structures. As a young investor, your long-term goal should be to transition from a mere consumer of financial products to a structural architect of your own wealth. This means understanding tax shielding, setting up clean corporate entities for your investments, and ensuring that your liability is completely ring-fenced. The elites do not own assets in their personal names. They control them through a web of trusts, corporations, and funds. If you want to build real security, you must adopt the same playbook. Start studying how to legally optimize your tax structure, protect your intellectual property, and allocate capital through entities that survive individual legal vulnerabilities. Third, let us analyze the massive narrative shift regarding blackmail, financial networks, and global capital. The transcript shows a complete retraction of the idea that high-level financier networks operate purely on leverage, but the global markets tell a different story. Information asymmetry is the single greatest driver of alpha in the investment world. Those who have the data make the money. Those who rely on public podcasts and speculative news cycles get left holding the bag. To protect your portfolio, you must become a sovereign analyst. Stop reading the sensationalized headlines and start reading the actual SEC filings, the earnings call transcripts, and the macroeconomic data feeds. When you base your investment decisions on raw, unmanipulated data rather than political talking points, you instantly insulate your portfolio from the chaos swirling around Washington. Look at how the broader markets responded to the entire Epstein file release over the past year. Certain sectors experienced brief volatility due to individual executive exposure, but the structural demand for technology, energy, and defense remained completely unbothered. That tells you exactly where the real power lies. It lies in the essential infrastructure of global civilization. If you align your personal investment strategy with the structural realities of global demand, no political scandal can destroy your net worth. Furthermore, the timing of this $5 million donation to the Congressional Leadership Fund is a stark reminder of the cost of compliance and regulatory capture. In the business world, regulations are often weaponized by dominant incumbents to crush smaller competitors. When a massive financial firm or a cabinet member has the leverage to deploy millions of dollars into the political ecosystem, it sets up a defensive barrier around their market share. As retail investors, we must recognize which industries are heavily protected by regulatory moats and which ones are exposed to total disruption. Investing in companies that possess unassailable regulatory moats or companies that are completely decentralized and immune to regulatory capture is a vital barbell strategy for the modern era. On one side of the barbell, you hold the deeply entrenched corporate giants that are functionally backed by the state. On the other side, you hold hyper-innovative, decentralized assets and exponential growth technologies that move too fast for a slow congressional committee to comprehend or restrict. This dual positioning ensures that whether the legacy system tightly controls the narrative or completely fractures under the weight of its own scandals, your capital is positioned to capture upside while minimizing catastrophic downside risk. Let us talk about the psychology of long-term investing when surrounded by a constant stream of systemic corruption and elite double standards. It is incredibly easy to become cynical, throw your hands up, and believe that the game is entirely rigged against the everyday investor. But cynicism is a losing financial strategy. Cynicism breeds inaction, and inaction ensures that inflation and systemic devaluation eat your purchasing power alive. Instead of letting these revelations make you cynical, let them make you calculated. Every time a transcript reveals an elite network protecting its own, let that be a signal to tighten your stop losses. Rebalance your asset allocation and double down on your personal financial education. The greatest act of defiance against a broken system is becoming entirely financially independent of it. When you do not rely on state subsidies, corporate handouts, or the stability of a specific political regime to fund your lifestyle, you win. Your financial freedom is your ultimate sovereignty. To get there, you need an aggressive, disciplined savings rate, combined with a highly strategic investment framework. You must automate your investments into broad market indexes, high-yield cash-flowing assets, and asymmetric growth opportunities. You must ignore the short-term noise of cabinet reshuffles, congressional grillings, and sensational media cycles. Treat the political landscape as an entertainment product, but treat the capital markets as an unforgiving, logical testing ground for your personal thesis. We are living through an era where the velocity of information is higher than it has ever been in human history. A transcript that would have taken months to leak a decade ago is now dissected on alternative media platforms within minutes of its release. This means market reactions are compressed, and volatility can spike instantly. To thrive in this high-velocity environment, your portfolio must be structurally resilient. It must not rely on perfect market conditions or untainted institutional behavior. Assume that corporate governance will fail. Assume that politicians will write checks to protect their interests, and assume that information will be manipulated. When you build a portfolio that assumes system-level friction, you are never surprised when the friction manifests. You simply execute your plan, adjust your hedges, and continue accumulating high-quality assets at a discount. Look at the actual numbers discussed in this report. A $5 million donation is an astronomical sum for a private citizen, but in the context of global capital flows and super PAC ecosystem dynamics, it is a line item. It is a cost of doing business at that specific altitude. Your goal is to scale your personal capital to the point where you are completely self-insulated, where the fluctuations of the dollar, the adjustments of capital gains taxes, or the political fallout of a department head do not alter your trajectory. This requires a complete shift in mindset. You must stop thinking like an employee or a casual observer and start thinking like a chief investment officer of your own life. Every dollar that passes through your hands is a soldier that can either be spent on temporary liabilities or deployed into the global market to fight for your financial freedom. Choose the latter. Align yourself with structural trends, build your knowledge base, stay disciplined, and let the legacy system burn its own credibility while you quietly build an empire of sustainable wealth. If you want to win in this macro environment, you have to look at the massive friction between public statements and private actions. As a structural reality of the market, when Howard Lutnick went on that podcast and built a narrative about never being in the same room as a disgraced financier, he was managing a brand, a corporate identity for Cantor Fitzgerald and his broader financial network. But the data revealed that business meetings, joint ventures, and family vacations occurred long after the initial public cutoff date. What does this tell us about corporate due diligence and asset analysis? It tells us that public relations are entirely decoupled from operational realities. When you are analyzing a company to invest your hard-earned capital, you cannot listen to the charismatic CEO on television or the polished founder on a marketing tour. You have to look at the verified audit trails, the balance sheets, and the actual transactional footprints. If a company claims it has completely severed ties with a toxic asset or a declining market segment, verify it through the notes in the financial statements. The truth is always buried in the fine print of the disclosure documents. Just like Lutnick's $5 million check was buried in the federal election filings, master the art of reading between the lines, and your investment win rate will skyrocket. Let us also address the concept of institutional path dependency and succession risk. The reporting highlights that Lutnick is a cabinet secretary in the direct line of presidential succession, managing the entire Commerce Department, which dictates international trade, export controls, and technological sanctions. When a key leader at that level becomes entangled in severe oversight disputes, it introduces massive structural friction into trade policies and international market stability. For investors, this means supply chain vulnerabilities and geopolitical alignments can shift overnight based on which officials are in the doghouse or facing administrative removal. To hedge against this specific brand of political risk, your equity portfolio must be globally diversified. Do not over-allocate your capital into a single jurisdiction that is highly susceptible to localized administrative chaos. Ensure you have exposure to international markets, emerging manufacturing hubs that operate outside the direct oversight of Washington friction, and companies with highly decentralized global footprints. When a multinational corporation can seamlessly pivot its supply chain from one country to another without relying on the specific whim of a single commerce secretary, that company possesses structural alpha. That is the kind of resilient asset that belongs in your long-term portfolio. Finally, consider the undeniable truth about criminal statutes and accountability highlighted by Title 18, Section 1001. In the capital markets, regulatory compliance is non-negotiable for the retail investor, while institutional actors often navigate the gray areas through massive financial resources and legal maneuvering. This structural asymmetry means that as an independent builder of wealth, your operational discipline must be absolutely flawless. Never cut corners on your financial reporting, your tax obligations, or your legal structures. The system is designed to absorb the shocks of elite errors while heavily penalizing retail mistakes. By maintaining an immaculate, highly disciplined approach to your personal financial tracking, asset documentation, and debt leverage, you eliminate the vulnerability that catches so many casual investors off guard. Keep your leverage low, your cash reserves high, your asset classes diversified, and your long-term vision completely locked in on sovereign wealth creation. The theater of the elites will continue to play out on the public stage, but your portfolio will remain an unassailable fortress of compounding growth, financial independence, and generational security. Stay focused on the data, ignore the political noise, execute your strategic plan with absolute discipline every single day, and watch your net worth compound over time.